Happy Thursday! Thank you all for joining us and welcome to our webinar for this month. Today, our presentation will be a little bit different than our typical webinars. We'll be focused on a variety of topics in sales tax, all based on questions submitted to us from you guys prior to the webinar. Your presenter today is Tax Connect's partner and consulting practice leader, Jeff Meggs. If you're looking for something a bit more in-depth on a specific topic, we participate in 1 to 2 webinars a month and will most likely cover it soon. But this will be more of a general overview of the questions, so won't be in-depth on one specific topic. But feel free to reach out if you have topics for us. We'd love to hear about them. Just email us or submit them in the chat box. A couple of housekeeping items before we get started. All your lines are on mute and will remain on mute throughout the webinar. If you have any questions, please submit them within the questions box on the GoToWebinar panel. We will take time at the end to answer your questions. Time willing, we will continue with questions at the end. We will do our best to get to all your questions, but if there are questions that will be more appropriately answered in private or very specific to you or your business, we may respond to those after the webinar in private. Thank you again for joining us today, and with that, I'll start with the agenda and some of the topics we'll be covering today. These are some of the sales tax topics that were submitted. So Jeff will be going over some of these. There's been some exciting recent legislative updates, so we'll cover some of that. Economic thresholds, Amazon and marketplace facilitators. Spend some time on drop shipments and exemptions, as well as state registrations and different nuances there. We'll talk about remote employees and if anything has changed due to the pandemic with those. And we'll also touch on VDAs. And as I mentioned, we will take time for questions at the end if there is time willing. But remember, some of these are, if they're very specific to your business, it may be harder for us to answer in a general way that makes sense to everybody. With that, I will pass it on to Jeff, and I'll start off with the first question. First question was submitted by Jason. Florida recently passed legislation creating economic nexus. What now?
Yeah, that's really fresh news, hot off the press stuff. I think it was just a week and a half ago that the governor signed this into law. Florida was one of the last 2 states to really come on board with an economic nexus standard for sales tax purposes. Missouri is now the only state outstanding. I suspect we'll hear something very soon. Maybe it happened today and I just haven't seen it yet. But it's coming. I think we'll see Missouri join a list of just about every state in the country that has a sales tax is going to then have a economic nexus threshold. So what we found, or what happened here in Florida, was they did institute or enact an economic nexus threshold of $100,000. That's really a gross receipts threshold. Generally, these thresholds that we're going to talk about today are usually what you really want to consider is the last 12 months. Some of the legislation and standards are calendar year, but if it's in the calendar year or the current year, once you hit these thresholds, that's when you have to consider registering and starting to comply with the sales tax laws. Now, in this particular case, as I said, this is a gross receipts threshold. So it could be that your activities in Florida may not even be subject to sales tax, but the fact of the matter might be that you're creating or establishing nexus, and then at that point, and from that point forward, you would have to consider any future sales as to whether or not they were taxable, and if they were taxable, then you would want to consider getting registered and starting some level of compliance. But the common thing that we like to convey to our clients, we deal a lot with small to mid-sized businesses. Materiality is relevant. It's not when you hit your first dollar of taxable sales that you rush to the registration line and get everything set up and start charging tax. That's admirable, and that's certainly what the law would like you to do. But the reality is there's a cost to compliance, and at some level you want to evaluate your compliance responsibilities and the systems or the protocols and processes that you have to put in place to meet those expectations. There's a cost to that. It could be that the cost of compliance exceeds the risk or the exposure. That happens quite often, and in those circumstances, companies sometimes decide to defer registration for some period of time, and defer charging tax. The most important thing I think to understand about charging tax is if you charge it, you've got to get it remitted within a reasonable period of time. Most of the states consider these trust funds, so once you charge that tax and put it on an invoice and collect it, it's now the state's money, and you're holding the state's money. They don't look kindly upon that if it's intentional. So just some things to think about. But this legislation will take effect 7/1/21, so on that date is when you'll start looking back at your prior gross receipts and evaluating whether or not you've met that threshold. We did comment on here that there's no minimum number of transactions. Why do we say that? Well, a number of states, as they instituted their economic thresholds, they also instituted, in addition to a revenue threshold, a transaction volume threshold. Most of them are around 200 transactions in the same period of time. And so it's an either, most of the states it's an either or. Some of the states it's an and. Most of it, it's either I meet the $100,000 threshold or I had more than 200 transactions during that same period. Florida doesn't have the transaction volume. And frankly, we're not big fans of the transaction thresholds. They're more of a nuisance threshold, in my opinion. Ultimately, at the end of the day, you're really thinking about this from a materiality perspective, a cost-benefit perspective. But anyway, what do I do now? You just have to put Florida in the same basket as every other state. And, while you still need to evaluate physical presence, that threshold or standard didn't go away. This is just an additional standard, an additional threshold that can be used as a bright line test for establishing nexus. So just pay attention to your revenues, look at the threshold. If you've got taxable sales, start to consider putting some type of a compliance process in place, getting registered and charging and collecting.
Okay, great. If any of you submitted questions and we're not answering those, feel free to reach out to us afterwards or submit a question too. If we can, we'd be happy to expand on it. So continuing with economic topics, so economic thresholds. Are economic thresholds based on gross or taxable sales? And this is from Charles.
Yeah, and hopefully I didn't answer too many of the questions that are coming up with my last answer, but I don't know if I touched on this before or not. Yeah, it's a very, very common question, and there's a standard phraseology that's used in sales tax that a lot of you have probably heard. Maybe you've been on a presentation of ours before, and I've been posed a question. And the standard phraseology is, it depends. Just about everything you can ask around sales taxes has that general response. And this is one of those, it really does depend, and it just depends on the state. So the majority of the states, the overwhelming majority of the states, as you can see here by this, not really a heat map, but a color-coded map, these are states in blue that have a gross receipt standard. So you don't have to distinguish between taxable versus non-taxable, retail versus wholesale. It's just gross receipts. And it's gross receipts for all revenue sources. So whether they're taxable revenue sources, whether they're service-oriented, whether they're tangible-oriented, generally they all get put in the same bucket. So that's generally the standard. As you can see, there are a few states here that aren't in the blue color. And just for those of you that aren't maybe sales tax savvy, let me point out a couple of things as well. There are 5 states that do not have a state level sales or use tax. And you're going to right away wonder if I'm smoking something over here, because I'll start with Alaska, which you see up there is blue. But it's Alaska, Delaware, New Hampshire, Montana, and Oregon. Those are the 5 states that do not have a state level sales tax. So why is Alaska blue, Jeff, if you just told us they don't have a state level sales? Well, Alaska does have city level sales taxes. Those are administered by the cities themselves, and it happens that those cities have formed a coalition, and in doing so, they've set their own nexus standard, economic nexus standard. So now if you sell into Alaska in excess of $100,000, they also have a 200 transaction threshold, then you will meet the threshold that allows a certain number of those cities to impose their taxing authority on you. Not all of the cities have signed up as of yet. I think there's still a few outstanding. A lot of them have, and they'll eventually probably get to 100% in that capacity. But if it's not gross receipts, what is it? And it can be a couple of different things. I've used the term taxable. Is it taxable or is it retail sales? And what does that really mean? What's the difference between the two? And the way I would describe it is there are certain circumstances where you will make retail sales, but those sales will actually be exempt from sales tax. A retail sale, for example, I was working with a client, I think it was late last week. They had retail sales of prescription drugs, which fell under a certain type of an exemption in the state. Those sales, being retail sales, would count towards the threshold if the state's threshold was based on all retail sales, even though they weren't taxable. So there are a few states that talk about taxable sales and some that talk about retail sales. You know, what I tell our clients is just focus on the gross receipts for now. Try to get some understanding and comprehension as to what your gross receipts are by state. Monitor that every quarter. See whether or not your prior 12 months of activity exceeds one of those thresholds, and then start drilling down into whether or not there's a need to do anything compliance-wise. Creating Nexus is only really telling you that the state has some level of authority to impose its taxing scheme on you. It doesn't mean that you have tax responsibilities yet. For example, our business, we're not registered in a lot of states. We have Nexus in a number of states, but what we provide in the way of service is not taxable in those states. So we're not registered for sales and use tax purposes.
Great.
Anything else on that?
Yeah, that's great. I'm not seeing any questions come in on that one, so we'll move on. This one I feel like is a topic we get questions a lot about. So Susan, thank you for submitting this. We're going to talk about Amazon and other marketplace facilitators. Susan submitted, I sell on Amazon as well as on my own website. How does selling on Amazon affect my Nexus?
And that question has been answered differently over the last decade or so. The evolution of our answer to that question, you know, early on we saw states enacting what we termed Amazon laws, which were essentially click-through laws. And what they were saying was if you're advertising product through a website of a third party and that third party gains some financial benefit once there's a sale transaction through that click-through, that can create Nexus for you if that website is housed or domiciled in that state. We graduated from that, and what happened over the time, particularly when we're talking about Amazon, Amazon, you know, exploded. They have warehouses all over the country. They have physical presence just about all over the country. They've taken some very, very well-defined stances and positions relative to their Nexus footprint over the course of time. But today, they're essentially, I'm not sure that what states they're not registered and filing in today. There's a good portion of the country is covered by Amazon now. So that being said, what if I'm selling through Amazon and if it's FBA type of a relationship, I may not have any other activities. I may not have my own website. I don't have any other physical activities in the state. I'm just selling through Amazon. Well, unfortunately, and outside of your control, Amazon can take your inventory, assuming they are managing your inventory and selling it. They can move that inventory all over the country at any time without your knowledge or control. It's part of their business model. And so what we have conveyed to our clients is wherever Amazon has physical Nexus, you should assume you have Nexus or potentially have Nexus. But there are sort of levels or degrees of Nexus. You know, there's the black and white variety. I've got a physical location or inventory or an office, And then when you get into stuff like this, it gets a little gray. There's not a definitive determination. You start having to make some generalizations. So I would suggest that if you are selling through Amazon, in most of the states, my anticipation is Amazon's probably covering your tax now already. So there's probably nothing for you to really worry about. However, if you are selling through Amazon and also selling through your own websites, that can get a little bit complicated, and you have to start taking into consideration, depending on the state, the volume of sales that are transacted through Amazon in a particular state, in addition to the volume of sales that you're transacting through your own website. So that could be an economic threshold that you're triggering. You could be creating nexus, as I described earlier, through that physical presence of inventory that Amazon's managing for you. So you may establish nexus in that regard, and even though your own website is very immaterial in terms of revenue, it could be taxable because you've established that physical presence. So it gets a little complicated. I still go back, I like to tell people, look, just keep track of your gross revenue by destination state. Where is it being shipped and sold into? And when that revenue starts to get at that 100,000 threshold, you need to start really asking questions. Do I have something I need to deal with there? So yes, you can create nexus by selling on Amazon beyond the physical or beyond the economic nexus standards.
Right, and this is mostly because they were also selling on their own website, or only if they're only selling through the marketplace facilitator, are they pretty much covered?
Well, not all the states have yet to enact a marketplace facilitator application of the economic nexus threshold. The vast majority have. So it's pretty likely that your sales are probably covered if they're going through Amazon. But if you only sell through Amazon and there is a potential you're creating economic nexus and a state like Missouri doesn't have a marketplace facilitator rule, then you could have physical nexus in Missouri through your relationship with Amazon, thus creating a responsibility to comply. But again, it can get a little complicated. We can always walk you through, there's so many different facets of those transactions. We can get together on a more personal level, one-on-one level, and work through those if we need to.
Okay, great. And this kind of spreads across the other marketplace facilitators as well. So eBay and Etsy would also be kind of included in this?
Yeah, that's a great point. We're not trying to give Amazon free advertising here. A marketplace facilitator, Amazon is just an example of one. They typically involve somebody that has a portal where your products are advertised or presented as being for sale, and that portal is owned by a third party who manages the placement and acceptance of the orders as well as the payment processing. And that generally fits the definition or category of a marketplace facilitator. And the majority of the states now have enacted similar economic nexus provisions for marketplace facilitators as they have for remote sellers.
Great. Thank you, Jeff. Let's move on to the next question. Looks like we're going to get into another tricky topic, drop shipments. All right, our question was submitted by Rose. Her question is, we are not a marketplace facilitator, but as a wholesaler, we act as a third-party shipper to our customer's customer. What responsibilities do we have?
Yeah, this is probably a good bit more complex and trickier than even the Amazon discussion that I maybe made sound harder than it really is. We refer to this as a drop shipment, and it's referred to as a drop shipment industry-wide. And a drop shipment here, we're going to illustrate it for you. It involves typically 3 different companies or entities, and in this example, we're going to have this transaction take place across 3 different states. In this particular example, we're going to use South Carolina as the quote-unquote retailer. So the question was posed by Rose, and in this scenario, Rose is going to be in Arkansas as the wholesaler distributor. And what's happening in our sort of e-commerce world today is there's just thousands and thousands of people who have started their own business. They don't maintain any inventory. They don't manufacture anything. They're simply a conduit whereby they can facilitate sales of products manufactured or imported by others. And so in this particular example, that entrepreneur in South Carolina started their own website. A customer, this is going to be the Illinois location, the customer goes to that website and purchases product. Instantaneously, that South Carolina retailer is going to reach out to the distributor in Arkansas, and they may have multiple distributors across the country that they reach out to depending on which product they're selling or where it needs to be delivered. But in this case, they reach out for the distributor in Arkansas to actually deliver the goods to Illinois, to the customer in Illinois. As Rose said, they are the wholesaler, and the Arkansas wholesaler in this case, what they see in this transaction is a sale at retail with shipment to Illinois. That makes this an Illinois situs transaction. Now we're going to assume this is all being handled with a common carrier shipment, a FedEx type shipment. There's not any other tricky situations involved here. The distributor is simply shipping via FedEx to that Illinois customer, and it happens in this case that the Arkansas wholesaler or distributor has nexus for sales tax purposes in Illinois. And the question becomes, what do? What's their responsibility? Well, in this particular transaction, they would be required to get an Illinois-specific resale certificate from that South Carolina retailer. Otherwise, they will have to charge that South Carolina retailer sales tax, and it will be Illinois sales tax on this specific transaction. The South Carolina retailer kind of throws their hands up in the air and says, I have no nexus in Illinois. You can't require me to issue an Illinois resale certificate. Well, the problem is they're conducting business, they're causing transactions to occur in Illinois, and if the distributor or wholesaler does have nexus in that destination state, they are obligated to fall within the rules and regulations of the state of Illinois. And the rules and regulations of the state of Illinois currently are you have to be registered in Illinois to be able to purchase something for resale exempt from sales tax. Now, what's interesting about drop shipments, and this example is actually fairly straightforward, there are a host of states. If we switched Illinois with, let's say, North Carolina, I believe might be one of them, there's a host of states that we could replace that box in Illinois with that would actually allow the South Carolina retailer to issue their home state, their South Carolina resale certificate to the distributor, and thus create an exempt sale for resale. And then at that point, the onus for the tax becomes on the matter of the customer having a use tax responsibility. That's probably a bit more complicated than you'd like for it to be, but I think the overarching message here is that if you're in that distributor wholesaler sort of business model and you have nexus in a number of states, you need to become familiar with what options exist for you to accept in the way of exemption certificates when shipping into those states. It can represent a good portion of your business, and at the end of the day, you want to be able to maximize your sales activity. So you want to be able to sell to that South Carolina vendor. You don't want to push them into a place where they feel compelled, because their profit margin's so thin, to go to another distributor who doesn't charge them tax.
Great. Yeah, I feel drop shipments is a question we get a lot of, and it's one I have trouble with a lot. We've actually done entire webinars or pieces of webinars on drop shipment, so you can check out our resources page. We do have more content on this topic. It is more of an in-depth topic for sure, and Jeff covers it great. Thank you for that. On to our next question, talking about exemptions. My vendor just began charging me sales tax and won't accept my resale certificate. What should I do? This is from Celine.
Yeah, this comes up every once in a while. Usually this happens when the transaction has some nuance, some uniqueness to it that doesn't fit the standard, let's call it the standard resale transaction. Generally speaking, resale exemption certificates are fairly standardized. They do come in almost an infinite number of varieties, and that's because a lot of the states will allow you to create your own exemption certificate. But in any case, if you're in this situation and you've got a vendor that just doesn't want to accept your exemption certificate, ask why they feel like it's not a valid exemption certificate, and then try to provide them with some statutory guidance, some legal authority that substantiates the fact that it's a legitimate certificate. We do see quite a bit of variety. There's a lot of really strange exemptions out there, and a lot of vendors, they're not customarily coming across those unique exemptions every day. And so these letters come to them that look really, really important and official, but they're hard to interpret. And once a vendor gets stung by a major sales tax audit, they'll get really gun shy about proper exemption certificates, and they'll become more and more strict over time. So it's something that you can expect to happen from time to time. What we would just encourage is provide them with substantiation for the validity of that exemption. Make sure you understand why it is they're refusing to accept it. It could be a minor issue that you could easily fix. And if they still won't accept it, there's not a whole lot you can do. They can pretty much decide not to sell to you, or at least to hold you liable or charge you sales tax, and hold that as a receivable over you until such time as they feel satisfied with your exemption documentation. We get involved sometimes with companies to just help them work through that. Sometimes there's some very complex leasing transactions, particularly when you get into finance leases, capital leases, and those structures can be such that the exemption certificate management is really critical. It's quite material, the sales tax issue is. So certainly if there's something more precise or detailed that we can help you with, we'd be happy to on that.
Okay, great. I think this next one kind of feeds into this one a bit. So still on exemptions. So this is from Joseph. When a reseller pays tax to a vendor in error on an exempt sale for resale, what options exist?
So, there's some general observations I'll make on this. Most often, we would ask the reseller to go back to their vendor, present them with the appropriate documentation to exempt the transaction, to validate the exemption, and then request a refund or a credit for those taxes that were paid in error. And if the transaction was fairly immaterial, there's probably no issue there. Most companies are used to dealing with that. They'll typically absorb that credit in their data for that month, and it'll just offset their current month's compliance liability. Sometimes, though, we're dealing with a rather large or significant transaction, or it just may be very complex. And the rules that the states outline, and again, the states all differ to some degree. So this isn't sort of the way every state works, but the majority of the states do want you and expect you to go first back to that vendor to seek that refund. There is a statute of limitations for refunds. Generally, it's either 36 or 48 months, depending on the state. There are some that are a little bit longer, but you do have time. So if you did, in fact, buy tangible personal property, you paid tax to the vendor, you then subsequently sold that tangible personal property without first using it, you made a retail sale, you charged collected tax to your customer, you do have to go back and get that tax from the vendor. If it's not something you can get from the vendor, or perhaps it's just not comfortable to go that route, and that could be both the vendor or the reseller who's uncomfortable, you could get what's called an assignment of rights. Not all states afford this luxury, but and I don't want to call it a luxury, that's probably an overstatement. But you could go and get that vendor who charged you the tax erroneously to execute an assignment of rights form. And it's really an affidavit saying that, yes, in fact, I did charge that customer tax, I did collect it, and I did remit it to the state, and I'm authorizing that customer to go directly to the state to recover that tax paid in error. And then you'll have to show proof to the state that it was paid in error, and the state will hopefully refund that back to you if it's legitimate. The third scenario, which is probably more common than number two actually, is absorbing the overpayment on your sales tax return. Depending on the materiality, the paperwork and the effort to go back and recover refunds can be just more struggle and more costly than it's worth. So a lot of companies will try to sort of bury it in some of their sales and use tax compliance function. I don't really encourage that unless it's very immaterial or it's something very unique, or it's a state like Texas. The state of Texas actually does allow for some of this. If you've paid tax to the vendor in error, you can in fact take credits on your sales tax returns. Now you're disclosing that you are taking the credits. You're not just absorbing it into the sales tax return. It's specifically bifurcated out, separately stated on that return for that particular period. So the message here is you've got the statute of limitations, 3-4 years at most. Again, you just have to understand which state you're dealing with. And then each state will publish their refund process and give you whatever options may exist in that state. Those are usually on their website.
Okay, great. We do have a question here, Jeff, that came in, and it may be pretty specific, but it's on this topic. So it may just be one of these three options you just gave. But Rebecca just asked, we have a customer in Oregon, and we ship their product to California. We are in Texas. We are charging California sales tax, but Oregon doesn't feel they should pay the sales tax. They have a certificate, but California won't accept it.
Yeah, so California, going back to that drop shipment scenario we talked about earlier, is very similar to Illinois. Essentially, you pretty much have to be registered in the state of California to be able to issue an exemption certificate. There are some exceptions to that rule, and I don't want to go too far down this path. One, because I don't necessarily have the best memory about it, so I don't want to say anything incorrectly. But two, it's fairly specific. But what I was going to describe is California has been known to allow for what we refer to as a pass-through exemption to apply. And what I mean by that is if that entity, that end user consumer, person that receives the shipment, is exempt specifically by statute for some reason in the state, it's possible that they could actually send their exemption to that Oregon company, and that Oregon company could pass that along to you as the distributor. That might qualify as a qualified exemption. It will depend greatly on what type of exemption documentation it is, so I can't tell you that everything's going to apply. But otherwise, that transaction does sound like a standard drop shipment. California is going to require that Oregon company be registered, or it's going to be taxable. That's the...
Great. Hope that answered your question, Rebecca. Again, you can follow up with us separately. If not, the specifics are a little hard to get into within the webinar. All right, let's move on to our next question. Moving to state registrations. This is submitted by Karen. At what point can you close your sales tax account if you no longer meet Nexus thresholds?
So we do have a Karen.
We do.
Sorry, Karen. So a couple of things. There's sort of a cost and aggravation of maintaining compliance. That typically is driving this decision. Somebody's saying to themselves, hey, why do I want to keep filing zero due returns in a state where I've stopped selling? I don't have any business activity. And I don't disagree with that theory. Let's get out of that practice. That being said, there are a couple things to consider. Once you do have sort of a pause or maybe a cessation of any taxable activity, or you don't have Nexus anymore, you just don't have any reason or requirement to be compliant. There is a standard that a lot of states utilize that we refer to as trailing Nexus, and that theory is simply that once you establish Nexus, you have Nexus for the trailing 12-month period. At the end of that trailing 12-month period, so long as there were no other activities that gave you nexus, you can then close your account and stop charging tax prospectively. So you got to be somewhat familiar with that rule of thumb. The other thing that we convey to our clients is it's not uncommon for you to have, depending on the type of business you're in, 2 or 3 sales during the course of a year, and then you might go another year without any sales, and then you might have another year with 2 or 3 sales. And assuming you have nexus during those time frames, I encourage people not to close their accounts. And the reason primarily is because if you're filing even zero due returns, you're keeping that statute of limitations running, and that can be favorable to you. Meaning that under audit, the state can only go back as far as 36 to 48 months if they're auditing a registered, compliant, timely filer. So even though you're filing zero due returns, you are at least protecting that statute and giving yourself a little bit of insulation should something happen during the course of that time that sort of gives you some risk.
It's a little bit more difficult to go back and forth, so you need to know.
Yeah, going into a state and registering and then leaving that state. Sometimes closing registrations are painful. The states will make it a little painful for you. Most of them are fairly straightforward, I would admit. It's a check of the box in a lot of cases. But then the whole registration process is a bit of a hassle. It's just not a fun experience to go in and out. It's usually a little less expensive to file 12 months of zero due returns than to close and reopen.
Makes sense. All right, moving on. Remote employees. I feel like this has been a big topic over the last year. We've gotten questions throughout the year on it for sure. This is submitted by Jennifer. With all the remote working and employees moving out of the state, won't it increase our sales tax exposure?
You would think so. Certainly having employees in a state is a pretty significant factor for physical nexus. So there have been a number of folks that have been concerned about this. There have been a few states that have come out proactively communicating that they don't intend to heavily enforce any nexus criteria, particularly if it's related to an employee who normally worked in the office, but for purposes of the pandemic was working from home, and that just happened to be in a different state. So if you're in cities on borders of states, this is a pretty common occurrence. The other thing I'd say about this is if maybe this could be your plan for business going forward. A lot of our clients have said, we're not going to force our employees to come back to the office. We'll let them live wherever they want. At that point, we then need to consider the state's statutes or the state's regulations associated with having an employee in the state relative to sales tax nexus. And some of the things we evaluate when we look at that is the employee there in a capacity that enables the company to establish or maintain a market? And those activities would be more along the lines of selling activities or maybe support of customers. Or are they purely an administrative function? They're back office, accounting type function. They don't have any real connection with customers or the market. They don't involve themselves in the market. They just happen to live in that state. There's no advantage to the company for them living there, and they could live anywhere and do the same job and have the same result. There are some arguments that could be made in those circumstances, depending on the state, where the state would respect that and say, okay, if that's all you're doing is some back office work, we're not going to deem you to have nexus or assert nexus in that scenario. So we do want to take a look at that. But I think the overarching message would be that states right now are themselves trying to figure things out. They've got their hands full. They're not aggressively looking to target companies that we've seen in this regard. I don't suspect they will. I think that in a weird way, the fact that we do have the economic nexus threshold in place probably is a good thing at this particular time and with these circumstances. Because I think a lot of the states are more apt to sit back and say, yeah, maybe that is an issue we ought to look at. Maybe we could pull some more taxpayers in. But the reality is those taxpayers can just move those employees just as easy as they ended up there in the first place, and they can change their nexus footprint that way. And ultimately, we've kind of established a bright line test for materiality and revenue that certainly kind of serves to cover the base or the majority of companies in that regard. So I just think it's not a real risky issue at this point.
Great. Okay, moving on. This next question was submitted by Ed, and it's talking about VDAs pre and post Wayfair. Is there more value to a VDA pre or post Wayfair?
Yeah, so similar to the drop shipments, I think we've done a presentation where we talk purely about VDAs.
We have, definitely.
VDAs, what is a VDA? A voluntary disclosure agreement. These are typically agreements and programs that are administered by states, and really virtually every state has some form of a VDA program. And what it really entails is companies that have been out of compliance in some degree. Usually it's a company that has had nexus, has had taxable sales, probably hasn't collected tax, but might have. They find themselves in the position where they're behind. They needed to have registered years ago. They needed to have complied and charged tax on their invoices, and they failed to do so. And now they've got to mitigate that risk. And so the voluntary disclosure programs are a great way to do that. There are two key benefits to a voluntary disclosure program. One is there's typically an automatic waiver of the penalties. So if you were audited without a VDA, the tax authority would come in, assess you the tax, impose penalties, and impose interest. If you go through the VDA program, usually the penalties are waived. If you've collected the tax and failed to remit it, there could be some penalties associated with that type of transaction or situation, but not always. A lot of times those penalties are waived as well. And then under the VDA program, you are going to pay interest. In some cases, that interest is discounted. Texas, for example, waives the interest if it's a pure voluntary disclosure of liability and no tax was collected. New York has an outrageous interest rate, about 14.5%. But if you go through the VDA program, they cut that in half. They give you a reduced interest rate for going through that program, plus the benefit of penalty. So that's sort of the basic benefit. The more attractive benefit to a voluntary disclosure, in my opinion, is what we refer to as the limited look-back period. And that is essentially the state saying, we're only going to go back as far as our normal statute of limitations. What they're saying to you is, by coming forward voluntarily, we're not going to penalize you for those periods that are beyond our statute of limitations, beyond that 36 or 48-month period, depending on the state. So long as you didn't charge and collect the tax, you can't benefit from the tax. But if you didn't charge or collect the benefit, or charge and collect the tax from your customer, we're going to forgive those periods. We're going to wipe them off the board. You don't have to worry about them ever again. You just need to come forward, disclose your current liabilities, pay your taxes that would have been due, and then we'll waive the penalties, give us the interest, and you're now registered and you're compliant moving forward. So that's the voluntary disclosure program. As we start to think about those programs after Wayfair, it gets kind of interesting. And it's a good question for this reason. Wayfair sort of established the new nexus threshold, or an additional nexus threshold that's economic in nature. So if the only reason you had a liability or responsibility to charge and collect tax in any one of these states was because you met the economic nexus threshold, well, that means that your nexus only started within the last 3 years. Those laws are all within the last 3 years. Generally, there's maybe a couple of exceptions. So in that instance, if you go back to the benefits of the VDA, you're losing that primary benefit, the thing that I think makes the VDA sexy, and that's the limited look-back period. If you're not going to get any advantage from that, and all you're going to get is the penalty abatement, there's not a lot of value in doing the VDA. And here's why I say that. If you didn't do the VDA, you just simply registered prospectively and started to comply, you are at risk for those periods. The state could come back in at any point in time and audit those periods and assess you that tax. They would likely impose the penalties. They will definitely impose the interest. So in terms of what the cost is, if you don't go down the VDA path, you're going to pay the same amount of tax as you would have paid under the VDA, and you're going to pay the same amount of interest, essentially, notwithstanding a couple of those states that give you some real benefits on interest. So now you're still breaking even at that point. And again, this is only if the only reason you had Nexus was Wayfair, you didn't collect tax beyond that period, you had no tax responsibility beyond that period. The thing that comes into play then is penalties. Penalties are the only wild card. And most states in your first audit, assuming this isn't gross negligence and intentional avoidance, most states will give you some relief of penalty under that first audit. It may not be complete waiver, but it will be some benefit. So where we go with this conversation a lot of times is, I ask the question, what's the intent of the business long term? Are you looking to position the business for some venture capital funding, or are you looking to sell the business in the next 2 to 3 years? If you are, then you need to anticipate that buyer or that investor is going to do some due diligence. And if it's a big enough deal, they'll invest enough that they'll bring the right people in to evaluate your sales tax exposure. And they'll pick up on this. And at that point, they're going to force your hand. They're going to force you to do something. So if you're in that position, if you're close to a sale, close to some type of due diligence effort, I encourage VDAs, even though it might be within the VDA or within the Wayfair periods. But more often than not, I talk people out of VDAs, and especially when it's a laundry list of states. The more states you got, the more of a calculated risk you can take. Because it's unlikely all of those states are going to identify you and audit you.
Makes sense. And I think that'll change as years go on, obviously. As we get further away from the Wayfair decision, you will have built up more of that exposure. But for now, that makes a lot of sense.
I will add one more thought, sort of contrary to what I just said, in a way. I think the states are starting to get proficient, and we're starting to see these questionnaires coming out. But the other thing that this economic nexus theory does for the states is it is more or less a bright line test. All they need to do is show that you had X number of dollars of revenue from their state in that 12-month period or that calendar year. So it is a lot easier for them to target, and it's a lot easier for them to fish the pond. I think there's just, they don't need as many lines in the water to identify candidates to catch. And so to Dana's point, I think there is going to be an evolution over the next few years where things will look a little bit different. We'll probably have a little different attitude around what to do with prior periods as that time goes by. So something to definitely think about.
Great. Thanks, Jeff. And he's definitely right. We go into a lot of detail in VDAs in our content and our webinars, and we do have previous webinars as well as an ebook on this as well. All right, last question, I believe. And I love when this question comes up. If you've attended our webinars before, we try not to talk about ourselves a whole lot. We want this to be educational for you. But this question does pop up every once in a while, and you know I love it. So thank you, John. What does Tax Connects do?
You said this is the last question. So this will be the marketing phase of the discussion.
Yes.
So unlikely to get a lot of good tax knowledge out of this last week. Please don't hang up just because of that, though.
We do have some other questions that have flown in.
So we'll try to address some more. Okay, good. Well, Tax Connects, I'll try to keep this at the elevator speech level. Essentially, we're an outsourced sales tax department for our clients, focused on primarily small to mid-sized companies that just can't afford the infrastructure of having in-house sales tax resources, whether that be technology or employees themselves. So our business model brings really high-level resources to partner with our clients. We hire CPAs or people with 5 to 7 years worth of sales and transaction tax experience. We engage those types of resources to really manage the relationship with our clients. They're managing the compliance calendar, all the returns and filings. We're not outsourcing anything to overseas or offshoring anything overseas. Everything's done here in the States. You have a direct link to your relationship manager. They are the ones that are actually managing your account and actually executing these filings. So there's not a team of people running through your data and just kind of processing it mindlessly. Your account manager understands your business, they're intimate with your data, and for that reason, they can help you through all of these types of activities. Exemption certificate management. We handle VDAs or amnesty programs. We do a lot of taxability work for clients. A lot of our newer clients, we first spend a good bit of time determining nexus for them. And then on the back end, when things start to materialize and you start to grow more mature, you're going to see audits come in, and we can handle and manage those audits for you. And we can play any one of these roles or all of these roles for any client. Every client's a little different in what their needs are or what their desires are. But it really is, we leverage technology. We've been in this business for about 23 years now overall. Tax Connects is about 11 years old. Our prior business was called Tax Partners. That was a business that served to outsource compliance as well for sales tax purposes, but more focused utilizing technology and for the Fortune 1000 companies that really had a pretty good, robust sales tax process and infrastructure in-house. So essentially, our slogan here, now it's all on us, it's really about just outsourcing the risk and the headaches. All the notices from the jurisdictions come directly to us. We just manage them, mitigate them. But that's it. That's our business. As Dana introduced me, I oversee more of the consulting aspects. Consulting is a very small piece of our business, but we will do ad hoc consulting work for clients. So you don't have to be a complete compliance outsourcer for us to work with you. So if you do need some help, and we can be of assistance, let us know. But that's us.
Yeah.
I think we're on the 38th floor on that particular elevator ride. So.
Well, thank you, Jeff. That comes to the end of our questions that were submitted before the webinar, but we have a few that have come in, and we do have a few more minutes. So if you haven't submitted a question yet, but you have one, please go ahead and send it in. One is from Joseph. It looks like we didn't completely answer his question before, and I'll read it out to you again, Jeff. But Joseph, I'm not sure if we can answer it completely on the fly, but so his question was, when a reseller pays tax to a vendor in error on an exempt sale for resale, what options exist? So he adds on to that, the retailer did not give the supplier a resale certificate. So did they have any options there?
Yeah, it's a good point. Generally the way the statutes are written in administrative policy is that you must issue your resale exemption certificate at the time of the sale or at the time of the transaction or prior to. And failure to do so does not meet the true form and substance of what the exemption certificate's all about. In reality and in practice, that's not the way it's managed. And it's extremely rare that a state doesn't allow for the subsequent issuance of a resale exemption certificate after the fact. This could be under audit, or even in a scenario where you have already paid the retailer or the vendor the tax. You might find that if you try to go back and get that refund, that they're not real favorable, not real willing to work with you. That can be a problem. I mean, again, going back to what I said earlier, there's some companies that are gun shy. They've been burned before, and they're just not willing to take that risk anymore. Hopefully, you're dealing with a vendor who's in one of those states where you might be able to get an assignment of rights. And usually the vendors are not going to withhold that right very often. There's no real benefit to them. Again, you may find some that are just scared. They're just nervous about it. They don't know what they don't know, and they just feel like they're at risk. It's about relationships and kind of trying to pursue the best viable solution. Sometimes you might be able to go to the state and get the state to give you that permission or give the vendor some sense of security that it's okay. But it is a little tricky. It's a good question. It does happen. I don't know. I might be able to argue that it happens more often that the exemption certificates are issued after the fact than before. I know that a lot of our companies, our clients, their practice is they'll issue the invoice and sometimes they'll sort of allocate that tax to a holding account until such time as they feel like enough time's passed that they're not going to get a resale certificate. And that might sort of span a 2-month period. So we have seen that sort of approach to try to protect themselves from remitting the tax and then having to go back to the state to get it back. It's not practical though. It's a real pain, to be honest with you. It's labor intensive to manage exemption certificates. You got to have your people on the front lines really asking those questions early in the sales cycle, or your accounts receivable departments need to be more proactive. So it's a challenge. If you've got a specific scenario that's not working for you right now and that this isn't helpful, let us know after the call. We'll be happy to talk with you about it a little bit more and see if there's something we can give you.
Great, thanks, Jeff. And absolutely, Joseph, reach out if we're still not answering that. Absolutely correct. All right, another one from George. This is probably going to be our last question. And George, we're probably going to have that standard answer for you of it depends. But George's question was, we sell a cloud-based service. Do we have to collect sales tax?
Well, it depends. There's a, no pun intended, there's a host of cloud type services out there. It really does depend. I'll just throw a couple of things out there. Software as a service is probably the most common sort of phrase that we're all accustomed to hearing, and it's a very common practice now that software is delivered in a subscription model that way. And there are a good number of states, I don't know, it might be close to half the states now have some level of sales tax that applies to software as a service. And sometimes those ancillary services are also taxable, which might be configuration or something along those lines. When you get into hosting services, platform as a service or infrastructure as a service, those tend to not be as taxable across the states as software as a service. But it is an ever-evolving area, and there are states where those types of services are taxable as well. General IT consulting services or remote monitoring services, again, each one of these has their own sort of category, and they're taxable in fewer states than general tangible personal property or most other transactions. But there's still states out there, there are states out there that like to tax these types of services and do. So it would be an it depends answer. But, the thing about technology, most of our clients are, I'd say the largest portion of our business is telecommunications and technology businesses. And it's because the ease of commerce for those companies, they can operate throughout the country at a moment's notice. There's no limitations. There's no logistics. It typically can happen whenever they want it to happen. So these economic nexus thresholds have hit the technology businesses the hardest and have made their lives more miserable than most other companies.
Awesome. Well, thank you, Jeff. And thank you all for joining us today. I think that's going to be the end of our webinar. I hope we got some of your questions answered, and if you have additional ones, please reach out. We will send a follow-up email to everybody with some links to some of the additional content we talked about. And we do have 1 to 2 webinars a month. We're looking to do something on audits in May. So look out for the invites on that, and we hope to see you there. Thank you so much. Have a great day.
Thank you, everybody.